Hello everyone. In this video, I'm going to continue my discussion about merchandising businesses, and we'll focus here on the revenue side. And here we're going to be covering sales transactions. So sales transactions is on the seller side, or in other words, it's on the supplier or the vendor side. So revenue from merchandise sales is usually recorded as sales. So this is the account that we use. And sales is, as I said, is related to revenue, so it has a credit nature. So whenever we want to record sales, we usually record it on the credit side. Sometimes a business may use the title sales of merchandise. However, it's less common, but the most common accounts that we see in businesses is either sales or sales revenue. So let's start with cash sales and see how the cash sales transactions are recorded. So let's see this example. Assume that on March 3rd, Net Solutions sells merchandise for $1,800. These cash sales are recorded as follows. So we record the date first, which is March 2019, March 3rd, 2019. Then we debit cash. And why we're debiting cash? Because cash is an asset. It's increasing. So we record it on the debit side because assets, they like the debit side. They increase on the debit side. And then on the credit side, we record the same amount, which is $1,800 for sales. And again, remember, sales is a revenue. It's recorded on the credit side whenever we are increasing. So using the Perpetual Inventory system, which is the one that we're going to focus on in this chapter, the cost of goods sold and the decrease in inventory are also recorded. So in this way, the inventory account indicates the amount of inventory in hand not sold, or in other words, the leftovers. So one thing I want you to remember, whenever we are recording a sales transaction, we're going to record two journal entries. One journal entry is what we've just seen like in two slides, and the second journal entry would be related to recording the cost of goods sold. So in the first journal entry, we recorded the sales, which is based on the selling price, and then the second journal entry would be recording the cost of goods sold, which is based on the cost of the items that we sold. So in this case, assume that the cost of the goods sold on March 3rd is $1,200. And remember, we sold it for $1,800. And that's pretty normal. Like most businesses would buy something at a lower cost than their selling price. So the journal entry to record the cost of goods sold and the decrease in the inventory would be as follows. We debit cost of goods sold, and I hope you remember from the very first video for chapter 5 that I told you cost of goods sold is like an expense account. So it has a debit nature also. Unlike revenues, they have a credit nature. So cost of goods sold has a debit nature. It's very similar to expenses, and that's why we're debiting the cost of goods sold for $1,200. And then we credit inventory because we want to reduce inventory based on its cost. So inventory is an asset. We're reducing it because we sold it. So we record it on the credit side for $1,200. So again, I want to stress on this. When we are recording a sales transaction, whether it's cash sales or credit sales, because I'm going to repeat that again whenever we're going over credit sales. But even if it's cash sales, we have to record two journal entries. One for the sales, and that's based on the selling price. And in our example here, it was the $1,800. And then the second journal entry is for the cost of goods sold, and that's based on the cost of the items that we sold. And in this case, it's $1,200. So sales may be made to customers using credit cards such as MasterCard or Visa. And again, in our world nowadays, the use of credit card is very common, and many customers or clients, they just use credit cards to make their payments. In our eyes, if the client or the customer is using a credit card, this is considered to be cash. It's not credit because we are not the ones who are offering the credit. It's the bank that offers the credit. So such sales are recorded as cash sales. Why is that? This is because these sales are normally processed by a clearinghouse that contacts the bank that issued the card. The issuing bank then electronically transfers cash directly to the retailer's bank account. Therefore, the retailer normally receives cash within a few days of making the credit card sales. So we're not really offering credit here. It's the bank that offers the credit. And the process is done through the clearinghouse. If customers use MasterCards to pay for their purchases, the sales would be recorded as shown in the March 3rd entry in the previous slide. Any processing fees charged by the clearinghouse or issuing bank are periodically recorded as an expense. This expense is normally reported on the income statement as an administrative expense. And we'll see some examples for how this. So let's see this example here. Assume that Net Solutions paid credit card processing fees of $4,150 on March 31st. And again, this is not just for the previous credit card transaction. Let's say that we have a bunch of credit card transactions, and these are the fees that we have to pay for the bank or to the bank for the credit card processing. So these fees would be recorded using the following entry, where we simply debit credit card expense, and it's for the value that's provided for us, which is $41.50, and then we credit cash for $41.50. So remember why we are debiting the credit card expense, because it's an expense, and expenses like to be recorded on the debit side. And why we're recording cash on the credit side, because it's a cash payment. So when we have a payment, this is reducing our asset, and assets, when they go down, they go on the credit side. Now let's see another situation here where we have sales on account. So Net Solutions sold merchandise on account for $1,800. The cost of goods sold was $10,800. So notice here we're given two values. We have the selling price, which is $18,000, and we have the cost of goods sold, which is $10,800. So the first value, which is the $18,000, is going to be used for the sales transaction, and the $10,800 is going to be used for the cost of goods sold transaction, or cost of goods sold journal entry. So on March 10th, which is the date that we made the payment, we made the sale, we debit accounts receivable instead of cash, because here we sold merchandise on account. The key term here is on account. So we sold it on account for $18,000. So we debit accounts receivable for whoever credit customer we provided. In this case, it's a company called Digital Technologies. And we credit sales, as we've done in the cash sales, on the credit side for $18,000. Then the second journal entry would be related to the cost of goods sold, and it has to be based on the $10,800. So in this case, we debit cost of goods sold, very similar to any kind of expense. So we debit it for $10,800, and then we credit inventory for the same value. Why we're crediting the inventory? Because inventory is going down, it's an asset. Assets, when they get down or they get reduced, we record them on the credit side. So unlike purchases, when we make a purchase transaction, it's only one journal entry, and it's only one value, because we don't know how much the supplier cost them. It doesn't matter to us. What matters is how much we paid for it. But whenever we're recording a sales transaction under the perpetual system, we have to record two journal entries. One for the sales, and that's based on the selling price, and the second one for the cost of goods sold, and it's based on the cost of the item sold. Now let's talk about customers' discounts. So sometimes, as we receive discounts from our suppliers, we offer discounts for our customers. So a seller may grant customers a variety of discounts. We call them customers' discount, as some kind of incentive to encourage customer to act in a way benefiting the seller. So for example, the seller may offer a customer discount to encourage customer to purchase in volume or order early. So these are called customer discounts. Sales discount encourages customers to pay their invoice early. So for example, a seller may offer credit terms of 210 net 30, which I hope you're experts in it right now, which means that we provide a 2% sales discount if the invoice is paid within 10 days, and the maximum period that we should receive our money is within 30 days. So let's see an example for customer discounts. So assume that Net Solutions sold $18,000 of merchandise to Digital Technologies on March 10th with credit terms 210 net 30. The March 10th sale would be recorded as follows. In this case, we assume that the customer is going to take advantage of this 2% discount, because any smart person would take advantage of that, because we've seen it before. 2% for paying 20 days sooner is equivalent to 36% per year. So what are we going to do? Again, we do the same traditional journal entry that we've just done, where we debit accounts receivable and credit sales, and this is based on the selling price. However, we're going to subtract 2% of the 18,000, and that would be 17,640. So we took the 18,000 minus 18,000 multiplied by 2%, and that was 17,640. Another way that I can do this is take the 18,000 multiplied by 98%, will give us the same value. The payment by Digital Technologies on March 19th is recorded as follows, where we get cash. So we receive the cash for 17,640, and we credit accounts receivable for 17,640. In this case, the cost of goods sold journal entry would be exactly as we've done before, where we debit cost of goods sold and we credit inventory based on the cost of the item sold. However, it's not presented in this slide. Now let's talk about cash refunds and allowances. When a buyer receives merchandise that is defective, damaged during shipment, or does not meet the buyer's expectation, the seller may pay the buyer a cash refund or grant a customer allowance. That reduces the accounts receivable owed to the original selling price. However, for the sake of this class, I'm skipping the part for making these estimates and making the cash refunds and customer allowances in the case of a sale. In the case of purchase, we've seen how this is done. So I'm going to stop at this point. In the next video, I'm going to be talking about freight.